Are back at it again here with another video with Invest for Tomorrow. To the first time viewers and investors, welcome to the channel. To all subscribers, welcome back. I'll ask for returns for to smash that like button. Tell me you watch this video. Helps out the YouTube channel and lets me know you appreciate the time and effort I put into making these videos. So here we are with the SPY. We're going to talk about the S&P 500 index and the overall market. And for the last 2 days, Thursday and Friday, the stock market has been going higher. And on Friday morning, our SPY bot sent out a bull indicator since 10:30 a.m. and call options from that moment forward went up 3 to 5x within minutes to an hour, guys. And this is something you can now gain access to as well. The link is down below in the description to the 42 vision indicator and the SPY bot. And this is our new release that allows us to have an edge within the volatility of the markets to maximize on opportunities, whether stocks or the overall market like the SPY is going up or going down. Now, as you see it, it's been going up for the last 2 days, and based off 42 vision, we have some things to talk about here in the bigger picture as well, and as we zoom in here on different time frames. But before we do, I want to share with you guys the home run opportunity I mentioned over at the Discord. And if you guys want to know about these stocks early on in the pre-market, check out the link down below in the description to the Discord. We look forward to having you join us, and we're going to jump into everything here with the S&P 500 index and the overall market. So the home run of the day was spectacular and beyond expectations. And if you guys want to know about these stocks early on in the pre-market, check out the link down below in the description to the Discord. And by joining, you'll become part of a growing community of investors, all looking to learn and grow together. So these are the 2 stocks I mentioned this morning. Both of them gave 5 to 10%, 10 to 15%. But one of them turned out to be 20% plus, and that was CYRN. And this stock actually had momentum the day before. We were watching it in its pre-market as it was pulling downwards under a bear indicator, consolidated, and started to pick up steam towards the bell, slightly pulled back, and then quickly things turned around, got that bull indicator, full strength on 42 vision, and it hit a highest point of 30% plus since we mentioned it in the pre-market, to its highest point of possibility, guys. If you guys want to know about these opportunities early on in the pre-market, we strive for them every single day, every single morning. Check out the link down below in the description to the Discord. We look forward to having you join us, and let's jump into these charts. So here we are with the SPY, the S&P 500 index, and it's had a 2-day rally, Thursday and Friday, and a lot of people are questioning, is this going to be a dead cat bounce or a real rally, and is it actually going to be able to hold itself up? Now, I'm going to pull up Ultimate 42 Vision, and we're going to look at the 30-minute first here, and we're going to talk about the technicals, and then we're going to go over to some of the reasoning behind this whole entire rally, right? Based off technicals and hard concrete data that suggests the possibility of something being priced in here, right? So let me pull up Ultimate 42 Vision, which is the bull and bear indicators that you can now gain access to as well. The link is down below in the description to the 42 vision indicator to receive the clarity you deserve within the volatility of the markets, whether stocks are going up or going down. So here we have it, right? We have 42 vision here having a complete shift from white with red borders to green, and then we're under a bull indicator since Thursday, way down here at 415, all the way to the highs here so far of 438, right? So things are looking pretty bullish here and so forth based off the 30-minute, right? But if I put the 1 hour and we zoom out a little bit, we have a technical setup here, and it's under a bull indicator as well that has created a double bottom effect, right? Way back here in January 24th, which was one of the times where the market first bottomed, and now we hit a slight new bottom, and now we've actually done the up, the down, the bounce, right? So that's the first thing, right? It's actually a technical run that's going on right here based off double bottom effects when you really look at it, and it's creating that W effect, right? The question is, could it hold itself up, and what was driving it to even happen? Because just a technical setup is one thing, but apart from that, there has to be a reason of what the market is pricing in. One of the first things that was actually being ignored as the stocks kept going lower was the fact that the 10-year treasury yield, when you look at it from its peak back on the 16th, all the way until the 21st, all the way back up to the 23rd, and towards now, it had dropped a little bit, right? Now it's kind of break even, but it was actually in a downward slope. and since the 16th. And if you look at the charts here, way back here on the 16th, we kept going down. Okay, the market was ignoring that, all right? And that's super important to realize. And I talked about it in one of my previous videos that we're going down and 10-year treasuries actually stabilizing and the market still hasn't priced it in. So the market was still fearful while that was happening. Now, if you really look at it, it's kind of bounced right back to the lows of the 16th and 17th, if you really think about it. So it has actually erased all of those losses that happened in the last several days and bouncing right back pretty quickly because of that. And then there's another hard concrete data that suggests that this is true, because when you look at the 10-year treasury, when things are going down, that means that there's less fear, or at least less pressure, right, of higher rate hikes, because this is like a forecast of what investors are feeling through the bond market of what's going to happen with interest rates. So this hit a peak here of 2.04 back on the 16th and 15th, and since then it's been going downwards. Even though it's not a lot, it was down to 1.92. That's a drastic change. Now it's kind of leveled off. So we need to watch this. This is super important, not just today, but moving forward towards the Fed meeting, because if this spikes back up and breaks through 2.04, that's where things could become a little bit concerning, and it's going to add fear to the markets again. Another way to notice that fear has actually slightly cooled off after how high it went is the VIX, right? Because it had spiked up to 37. I stated in my previous videos, if we saw this break through 30 and it broke through 32, we would see this fly out to newer highs and the market could possibly pull back. That's what I talked about in my last video. And here we are seeing it go up to 37 and come back down. So if this continues to either stay flat or go back down even lower, that's going to be a big sign of fear subsiding and the volatility, instead of pulling everything down at once. Even though there's still going to be volatility back and forth, the market is going to have a breath, right, of not falling, but coming back up, as it has been for the last several days. So super important. What we want to see is the VIX go below 24. And what we don't want to see it do is break through 30 and 32 again, creating further volatility than what we've seen in the last several days and weeks, right? So when you look at the SPY and you look at the VIX, they're doing the opposite, right? And this has been going up while the VIX has been falling. So it's almost like this was a point, just because it's not peak fear. We don't even know where peak fear is. The market is reacting to it in the sense like 37 is the highest that we've seen for literally the 52-week range almost, right? The last time we hit a high up there was 38. That was back in January where we dipped. Now we dipped again, and it's almost like we hit a peak fear moment right now. It doesn't signify it's the peak. It could actually reverse right back up, but it signifies that we rejected it. We're going down on the VIX, and the SPY reacted the opposite, right? Going back up. But this is the data that actually suggests why this is all happening, and it has to do with the Fed, okay? So the heading here says Goldman boosts rate hike forecast, and the firm now sees 7 25 basis point rate hikes in 2022, and they've stated this since the beginning of February. And if you look at it here, they state that the firm acknowledges there are arguments for the 50 basis point rate hikes in March, but most of the Fed officials, okay, the small majority, right, the large majority are actually against 50 basis points. So a lot of the market is pricing in the possibility of 50 basis points, but what if it turns out to be more likely that the path is the longer series of 25 basis points? That can be that soft landing that everyone's expecting and wants to not create a shock in the markets. And there's a reason why the likelihood of this has become more predominant. There's a reason for it. And it has to do with the exact same words that this analysis and expert is stating. And he's not the only one that's come out and stated this. Many of them are coming out and actually stating that a much more aggressive rate hike is probably off the table as the tensions globally continue, and the Fed will have to tolerate higher inflation. So instead of coming at it with the 50 basis points, much more aggressive, much more of a hawk. They have to turn back to dovish based off 25 basis points each time. And they're not the only ones stating this. We have banks, JP Morgan, Goldman Sachs. Okay, that's two large banks that are seeing not 50 basis points per time, but if not 25. Now some are saying 7, some are saying 9. Whatever it is, 25 is much more of a slower pace and less aggressive, and it turns everything into a much more dovish approach in the eyes of the markets. Okay, this is about markets. This is not about fear or market manipulation. This has to do with the Fed's decisions. I always say this, I state it to the group, and if you're hearing this part of the video, you're learning something new, and it's super important to realize that the Fed's decisions have the biggest impact on the overall market. It's super important to realize that, because in between each meeting or decision the Fed makes, there could be headings or different fear or different positive catalysts to individual stocks or the overall market. But the bigger picture, no matter what stock or what part of the market it is affected by the Fed's decisions. So this type of approach is being priced in already by the bond markets. You could see how things peaked and pulled downwards. Now we need to watch from this level forward if this will continue to be priced in, because if it levels off and it doesn't go too much to the upside or downside, that's healthy as well. The lower this goes, the more dovish the Fed is being priced in the overall market with the bond and also the overall regular markets as well. Also pay attention to tech, right? If tech continues to run and have such type of volatility to the upside, I mean, it's double bottom as well, just like the S&P 500 index. But if it continues to run altogether, then this is showing you that there's more risk on, because the markets are pricing in a dovish Fed. Now, it's not guaranteed, but all this data together suggests that there might be a more dovish approach. And if it does happen, it will continue this type of direction. We don't know if we've bottomed out yet, but this right now seems to be one of the most significant bottoms by far in this whole entire year. Now, based off when you look at today, right, from history at the beginning of the year to today, based off of an analysis and technical perspective, the lowest point we know is 410. Will we retest it or break through it? We do not know. But what we do know right now, this was the lowest point we have seen in the market overall in the whole year. Now, a month from now or two, we'll know if this was the bottom or if we'll retest it or break through it. But this is not financial advice, but this is how large investors and hedge funds are approaching it and have always approached it through the history of investing, right? Sometimes we don't have the patience as individual investors to do this, but it's called average costs into your positions, right? Averaging their costs into everything. And when you look at it, this was one of the lowest dips we knew since the beginning of the year till the end of the month in January. And this is one of the lowest dips we know so far of the year. If you are an investor, right? Or just let me use myself as an example. And again, not financial advice, just my opinion. I go ahead and buy a stock here, and I go ahead and buy a stock here. These 2 points right here are the best points of average costing into my position to go ahead and try to catch the bottoms, right? There's no such thing as being able to specifically catch the bottom or time the market, but what one can do with confidence is when these dips happen, there's an opportunity, right? And for the theory and example purposes here, I'm going to keep it simple, just buying one share here and one share here just to put it into perspective. Again, not financial advice, but my opinion. If I bought one share here at 426 and another one here at 410, let's just say I caught those two dips, in between the two would give me the average, right? Which would fall somewhere between, 415 to 420, somewhere around that area, right? And if I average cost into both of these at this bounce, I would be up about a 5 to 10% move just within this bounce. That's where the power of averaging cost in comes into play, because no one can time the bottoms, but if one can actually have the courage to catch bottoms and keep their average cost as low as possible, when there's a bounce, there's an opportunity to lock in profits or feel the confidence that one has caught probably one of the best prices you'll know for quite some time, right? And that's how large investors react. And they buy dips over the course of time. They don't just buy any dip, they strategically buy dips, right? If something double bottoms, if something breaks the most recent bottom and stuff like that. And like I said earlier in the video, these two bottoms in their present day, at the time of January 25th, 26th, 24th, this was the lowest we had seen the SPY, right? And now at present day, the 24th, 25th, these were the best prices that we've seen so far. Doesn't mean that they will be the only best prices. We do not know to that extent. We need to see how things play out. But right now, what we do know, based off of everything that I shared in the video, that this whole entire market is pricing in a dovish Fed. We need to see if it continues. We may continue to see volatility because of different headlines, different fear. But remember, behind the scenes, the bigger picture is actually based off the decisions the Fed makes. And one of the ways to watch how fear is looking is tracking the VIX, how it's doing. We want to see it go below 24 for a much more bullish run and much more positive sentiment in the market. And we want to see it not break through 30. And if it does, things may get bearish again. And specifically if it breaks through 32 and tries to hit the highs again of 37, 38. Remember that. And then on top of that, we will want to watch the 10-year Treasury, because the 10-year Treasury has cooled off from its highs and it's kind of just consolidating there, but it's had a lot of volatility the last several days. But if it stays down here between 1.9, 1.8, that is going to be a huge sign of the whole entire market pricing in a much more dovish approach in the bond market, and the whole entire overall market may continue to have an upward trend. Not a straight line like we've seen here. It might be something like pullbacks up and down, but it's going to be in the overall upward direction, right? That's what we want to see. Something like what happened here, but to continue, right? Not get pulled right back down. We'll see what happens leading into the Fed meeting. If the Fed turns out to be dovish, that's going to be a huge catalyst, and the markets are probably going to be excited until the day that the market decides to actually react to the Fed's decisions of becoming hawkish again, because that can happen too. Don't forget, right now it seems dovish, and if they do go ahead and proceed being dovish, they can turn hawkish at any point in time. So there's going to be a lot of volatility. I'm going to continue to watch 42 Vision, Ultimate 42 Vision. And the one big thing here is the 1 week, guys. We've been under a bear indicator. And as I've shown before in my previous videos, these do not pop up for several days. They pop up for several months and weeks at a time. And I'm going to be watching for this to actually hit white with red borders and have an eventual reversal and the next bull indicator, because when those bull indicators pop up, they do last for months to years at a time. So right now on the 1 week, we are under a bear indicator. Things continue to go lower. I'm going to be watching it, and we'll see if this tries to reverse or it still has room to retest lows and break through new lows based off the pressure of this still looking bearish, even though within the volatility, there's up and down movements, but the bigger picture is still looking down. As always, guys, thank you guys so much for watching, and let's make some money.